welcome to our webinar today. We have our guest, Lauren Wells. She's going to be joining us to talk about how to evaluate deals and sponsors. And to get us started, I'm going to talk a little bit about Advanta and how you can make those alternative investments with your retirement account in case you're not familiar. As we go through the presentation, please feel free to go ahead and type any questions you have into the question box, and we will make sure to get those answered as we go through the presentation. My name is Larissa Green. I'm with Advanta IRA. I've been here almost 13 years, and I've done a little bit of everything at Advanta, but I am currently doing business development, marketing, and education for Advanta. Do a lot of networking for the group and a lot of educational presentations. Today, we're going to focus on the topic with our guest, but if you're ever looking for a deeper dive into self-directed IRAs and more specifically different types of investments and how they work within the IRA, please let us know. We're happy to send you any recorded webinars we have, and we're always taking suggestions for topics you'd like to hear. My contact information is on the screen, so if you have a question about a self-directed IRA, and maybe it's a little more personal or you would like to discuss it further, you can feel free to reach out to me. My direct extension and email address are there for you on the screen. Just keep in mind as we go through the presentation today that we don't give tax, legal, or investment advice. Everything is for educational purposes only, but please feel free to ask questions. We definitely encourage you to do that. If it's something we can't answer, we will definitely let you know that, hey, that's going to be something for your tax professional or maybe your attorney to answer. But just keep in mind that we are not those advisors for you. Advanta IRA has over 20 years of experience in self-directed IRAs. This is, I believe, our 22nd year in business. And so we've been doing this a long time. And what really makes us stand out compared to other companies that do the same thing is that every account receives a dedicated account manager, and that person is with them for the life of the account. So not just during your investment period, but also if you're making contributions, transferring money in and out. If you have questions about investments that you'd like to do and you're not sure how that would work within the IRA, that person is there to answer those questions for you. We have $3 billion in assets, a little over $3 billion in assets under administration, and we do have two offices, one in Clearwater, Florida, and then Atlanta, Georgia. But we can help anyone, anywhere. As a matter of fact, we even have clients worldwide. So as long as you have a U.S.-based retirement account, you can self-direct it, and we can help you with that. As I mentioned, we have events going on all the time, a lot of educational events. Actually, we do 2 webinars a week. We also have a podcast and a blog, and we're always just really trying to get information out there to you. We just recently did a webinar on updates from Secure Act 2.0 and how actually people are implementing updates from Secure Act 2.0 into retirement accounts now. It took a little bit because we were waiting on some more information from the IRS on record keeping, but now you're going to see a lot of custodians and administrators actually implementing those changes. So that podcast is a good one. If you're interested, please feel free to email me and I'll get that information over to you. You can also check out all of the events at advantaira.com/events. So what is a self-directed IRA? I actually did a presentation yesterday where somebody said to me, I hear self-directed a lot, but not every custodian will hold private investments. So what is the difference? When we're talking about a self-directed account, we're talking about something truly self-directed. We don't sell you anything at all. We simply hold the account, you find the investment, and we help you get it done in the name of the retirement account so that it retains its tax-deferred or tax-free status. Yes, there are a lot of brokerage accounts out there that have self-directed accounts, but they're still allowing you to only invest in what they can offer through their platform. So just keep that in mind. It doesn't make it bad, it's just different. And so if you want to truly diversify your portfolio, you can self-direct with a brokerage firm and have some money in the market, but then you can also move whatever amount you wish to truly self-direct over to Advanta IRA, and we can help you make those private investments. So what types of investments are people making with their self-directed accounts? Honestly, the list goes on and on. There's only 2 things you can't do. That's life insurance and collectibles. And so when you think about the alternative possibilities, they're nearly endless. You can invest in real estate, mortgages and unsecured notes, private placements, precious metals, cryptocurrency syndication. And actually, like I said, it really could be just about anything you can think of. We have clients invested in things like crypts and airplanes. We have people invested in sports teams and racehorses. So if it's something that you know and understand and you want your retirement account to grow in that investment, you can certainly do that. So with that, I'm going to introduce you to Lauren. Lauren is joining us today, and she's going to talk to us about how to evaluate deals and sponsors. How are you doing today, Lauren?
I'm doing well. Thanks so much for having me and happy to be here.
Great, thank you. And I think you should have control now. And I just want to remind everybody too as well, please make sure to type any questions you have into the chat box. We're happy to answer those.
Awesome. Thanks so much. Thanks for having me here. Happy to be here and kind of talk about something that I feel like isn't spoken about often enough, especially when you are considering where to allocate funds, whether it's in a self-directed account or a cash account, is really evaluating deals and then also sponsors and then really what's available to you as an investor based on, certain criteria. So I'll give you a little bit of background about who I am and why I feel qualified to talk about this, and then we'll kind of go from there. So I, always have our disclaimers up. Encourage you, if you're watching the recording, to reread these. So I'll talk a little bit about our backstory. Who is 70? Who am I? Active versus passive investing. I think this is a really, talk to passive investing kind of is the buzzword, but I think a lot of times, sometimes people think they're investing in passive and it turns out to be active. So talking a little bit about that. Different types of funds and evaluating the people and the sponsors behind them, and then a little bit about what we do at 7E. So my backstory, I actually worked a corporate job, W-2 job in software sales here in California, like very much what you would probably see on one of those Silicon Valley TV shows. Out of college, I also was volunteer coaching for a local high school water polo team, as I am a former collegiate water polo player myself. And what I realized when I was coaching these high school girls was that the parents who were showing up to all the games, the practices, the tournaments, everything, which basically seemed like a job in and of itself at the time for them, either own their own business or were investing in real estate. So at that point, I started doing probably similar to what you might be doing today, attending self-directed IRA webinars, researching different investment avenues, both active and passive, attending local real estate investment networking groups, and just trying to learn as much as possible so I could figure out how I would want to invest in real estate. I stumbled across mortgage notes and actually built my own portfolio, which then led me to meet my current business partner, Chris, and I've managed over 600 deals and have had 5 funds go full cycle in the past. But what I realized along the way was that not everyone had access or knew about these types of offerings, both from a accreditation standpoint. It seemed like most of the funds wanted 50 to 100K minimum, or they just weren't widely talked about. You hear a lot about stocks, bonds, and mutual funds, but you don't really hear a lot about other ways to invest passively. So that really led us to start 7E Investments and make this asset class available to the masses. There we go. So at CWS, we are a private real estate investment company based in Virginia, and we purchase performing and non-performing mortgages that are secured by real estate. In short, we like to say we fix and flip mortgage notes. So what we're doing is we're buying these loans at a discount, modifying them with the borrower, getting them back on track, and then selling them back to the secondary market. Maybe you're sitting here and you've owned a home and you currently own your home, and maybe you've received a letter in the mail that said, hey, your Union Bank sold your loan to Chase Bank, so now send all your payments there. I remember prior to being a note investor that I received that for my first home and was very confused on what that meant. My loan was sold, I didn't do anything wrong. Well, loans are sold, an average of 7 times if they're held to maturity. So it's a very common thing, and what 7E does is we're the people buying them. So just a little bit about who we are and what we do. Our mission is really to democratize investment opportunities. That's why I'm so passionate about sharing both the education behind evaluating deals, sponsors, and what might be a fit for you, and then also providing our investors and our borrowers with win-win solutions. So I really want to start here because I feel like this is something that when I first started looking to invest in real estate, I wanted passive income. It was passive income. How do I get passive income? And I looked at, short-term rentals, buy and hold, wholesaling, all the things. which I then realized were actually very active. So really talking about the difference here between the two. So with active investing, there are some pros, and I know, some of my former colleagues and some friends of mine are active investors, and they really like it because they like the control over the decisions being made about their investment. They have more flexibility, and there's more possible tax benefits. However, it is more time consuming. So if they have a W-2 job and kids and other commitments, it might be harder to be an active investor because it does take up more time. Even a long-term rental, I've had them myself, are not considered truly passive, getting calls from tenants about, whatever issue at any time of day, any time of night. So they are more time consuming. There's typically a higher barrier to entry. So this is one that I think a lot of people don't consider, is when you're an active investor, if you're going, for example, to buy a short-term rental, you're investing in that entire property yourself, or maybe with like two other partners. So you're having to come up with more cash. There is a higher barrier to entry to get started, and it's typically all allocated to one specific asset, and therefore more costly, and you have more to lose. There's more skin in the game. Now, when you look at passive investing, true passive investing is where there is zero time needed. You are receiving a check, a dividend, or tax benefits. It allows you to diversify your investments because, again, you're not all in on one property or two properties, and it's a lower barrier to entry. Typically, you're looking at, anywhere from, with a Reg A fund, 5,000, even lower sometimes, to 25, 50, 100,000, just really depends on what kind of funds you're looking at. Cons to passive investing, you need to have trust in the sponsor, and that's why I'm going to talk a little bit about that. Like, what does that look like? How do you evaluate the person behind the deal? You really are giving up that control for the passive aspect of it. So you're trusting that this sponsor is going to make the decisions that are in the best interest of all of the investors. And sometimes it can have lower returns, again, because you're not doing the work. So the sponsor might take a fee or something on top of that. So the three main categories of investment funds, I think if we're kind of looking at this as I'm going to look at this like a funnel, for example. So you decide, okay, I want to be a passive investor. I have a W-2 job, and my life is super busy, but I have this cash, I want to invest, and I want it to start growing or paying me dividends, whatever that might be. So then you look at really what are the three different kind of categories of funds that I might be interested in. And typically a good portfolio has a balanced mix of all three of these. Now, depending on where you are at in your phase of life, some might look more attractive than others. Tax advantage, that doesn't really apply too much if you're looking to invest with a self-directed IRA account, but I will mention it. Things like oil and gas, they reduce your taxable income, offer tax-free growth or withdrawals, and it's really useful for long-term financial planning, offsetting capital gains. You also then have your growth, and this is really where you're wanting to set something that will increase in value over time. You're not necessarily concerned about getting paid back right away. You want capital growth rather than the income. These investments may be more volatile and carry a higher risk, but higher reward as well. So these are considered kind of higher risk, higher reward. And then you have your income. These are really for people who are focused on generating regular income, monthly, quarterly, annually, whatever that might be. It's really favored by investors who want the steady cash flow, whether to offset, their retirement funds or their income to, we have a lot of investors who do it to subsidize their kids' daycare, college fund, car payment, all of the things. And typically it's a less risky type of investment with a little bit maybe lower returns than your growth. Again, because you are getting that monthly income, or quarterly or annually, depending on how the sponsor set it up. Now, say you're saying, okay, I want an income investment. I really want to focus right now on income. Then you got to look at the types of assets and which ones appeal to you. Obviously, most people are familiar with stocks and bonds, and then there's real estate offerings, there's oil and gas, there's private placements and syndications. So really looking into, okay, things that I need to consider. What is my risk tolerance? What return profile am I looking for? And really what is achievable? You know, anyone can say, I'll offer you a 20% return, but then you have to really look at what the risk tolerance is there. So risk reward, considering that. What is going on in the market? Are interest rates, you know, going to affect something I'm investing in? Is, you know, looking at what's going on, employment, jobs, housing, kind of looking at what's going on. What are your goals? Is it for you to, again, get that monthly income to subsidize your cost of living? And what is the time frame you feel comfortable investing? And when I mention time frame, most funds, syndications, private placements, oil and gas deals all have some sort of lockup period, whether that's 1 year, 10 years. I've seen some as long as 15. So how long am I okay with my money being, you know, allocated to this sponsor? And that really brings you to then the two different types of funds. You know, you have your Reg A and your Reg D. Now, if you're sitting on this call, most of you might be familiar with a Reg D fund, or maybe you don't even know it's called that, but that's probably what it is. There is no limit on the size of capital that the fund can raise. It is only open to accredited investors, and this is probably the biggest differentiator between the two. Maybe not. Disclosures and reporting requirements, there are none for Reg Ds, and there's no qualification costs. So essentially with a Reg D fund, me and a business partner could go write up a PPM, which is a private placement memorandum, basically outlining the full terms and conditions of our offering. We would then go file that with the SEC and be on our way to raise capital. Now, with the Reg A fund, unique because you can raise capital from anyone, accredited or non-accredited. It does not matter. There is no barrier to entry there. You're limited to raising 75 million in a given year. And then in order to do all of this, you actually have to get SEC approval. So instead of just filing with the SEC as a Reg D funds do, you have to actually submit what it's called an offering circular. It's the counterpart to a PPM. And you're submitting that with the SEC, and they basically have to bless it. They have to say, yes, you know, this makes sense. Typically, that evaluation process can take anywhere from 6 months to a year, with multiple comments going back and forth between the SEC and the sponsor. And you're all the while filing, you know, and putting up the cost of working with them, which is not, you know, not cheap, we'll say. Essentially, they need, their job at the SEC is to protect investors, and so they feel that if they're allowing you to raise money from non-accredited investors, that they need to qualify your offering in order for you to raise money. So a little bit different, much more strict regulations when it comes to Reg A than Reg D, and typically a lower barrier to entry with the Reg A. So we talked about this for those who may not know, accreditation status, who qualifies. Accredited investors really either have to hit one of the three criteria. They have to hold a Series 6, 7, 65, or 82 license, and that's with FINRA, to be able to sell securities or invest in securities. Typically, that's financial advisors have those, brokers, RIAs, or you have to have a net worth exceeding 1 million, excluding the value of the primary residence, or you have to have a combined income exceeding 200,000 during each of the last 2 calendar years, or 300,000 if combined with a spouse. So in order to even invest in a Reg D offering, you have to meet one of these 3 criteria. Now, if you're not an accredited investor, it's really anyone with acumen and experience to evaluate risks, but they don't meet the requirements of an accredited investor. And that really, if you're not accredited, it limits what you're able to invest in. Typically, you're looking at a crowdfunding or a Reg A, or you're being more of an active investor. So it doesn't discount you from being an active investor and purchasing, you know, a rental property. But when it comes to that truly passive income and different types of funds, you are more limited. This is all great. You may say, okay, I know I'm not accredited, so I want to invest in a Reg A fund. I want income, and I want it to be real estate specific. Then you're Googling or hitting up Bigger Pockets or seeing what sponsors Advanta has worked with, or, you know, reaching out to peers about what funds that they've invested with. And that's where it comes to vetting a sponsor. And how do you do that? How do you learn to get to know how someone is going to operate in good times and in bad.
Oh, Lauren,
So
before you go on to accredited investor or deal sponsors, I had a question. When somebody is completing forms for an investment into a Reg D, what
mhm.
types of questions are they going to be asking, and what kind of supporting documentation do you typically see for that sort of stuff? So, of course, they're going to be asked, why, what makes them qualified, and then sort of documentation goes along with that.
Yeah, that's a great question. So typically, if you're investing in a Reg D, there's a page of their paperwork that you're filling out that will ask you, is your net worth over a million, or is your annual income 200,000 if you're single, or 300,000 for the last few years if you're married, or do you have one of these licenses? And it's really like a one-page piece of paper where you're checking the box and attesting to that. Now, they should also then be collecting a proof of accreditation, and that can come in a few forms. If you have a CPA or an attorney that you work with, and they can write a letter that says, hey, this my client, is an accredited investor based on X, Y, and Z. Most CPAs and attorneys are familiar with having to write that letter for their clients, so you can ask them for that. It's an accreditation letter of accreditation. However, we have investors that will just provide us with bank statements that equal up to, or you can do tax returns that show income, or bank statements that show net worth. So some of our clients will say, I have a net worth of over a million. Here are my brokerage accounts. They'll dot out the accounts and send us the statements, and that we have to keep on file, and if they don't ask for that, again, that to me would be a red flag, because if at any time the SEC were to audit them, which happens all the time, they would not be in compliance, and it would not be great. So I would be I would be a little bit not at ease if someone didn't ask me for paperwork to verify my accreditation. So it's a one-page document you check and sign, and then you have to provide the supporting docs separately as well, or you should have to provide the supporting docs separately.
Got it. Thank you.
Yeah. So sponsor track record. This is super something that I think a lot of people talk about, but I think there's also ways you can learn to validate it. So who is this person? Who's on their team? Who's working with them? What is their experience? Have they had other offerings in the past? And how have those played out? Have they gone full cycle? Meaning, have they raised capital, deployed the capital, returned the capital to the investors per the terms of their PPM? Do they have reviews or testimonials? Go to Google, go to Bigger Pockets, ask people, have you heard of 70 or have you heard of XYZ company? I always want to know what people think in those communities. Those investor communities are huge, and typically there's at least one person who's either invested with them, not invested with them, or has something to say. And then, do they have a track record verification report? Now, this is something that I don't feel a lot of people know about or know to ask about. And this is something that is available for sponsors to get done at the expense of the sponsor. Essentially, they are hiring an independent third party to audit their past funds and how they calculated their returns, so that when they say, oh, we've had 5 funds go full cycle and this was our return, anyone can put that on a slide and say that, but do they have a track record verification report to back it up, to say that a independent auditor came in, looked at the bank statements, looked at what was going in and out for that fund, asked how we calculated our returns, and really audited each fund to say, yes, in fact, we are verifying that those past 4 or 5 funds did return this to the investors. So it's called the track record verification report. I feel like it's going to be more and more common in the coming years that we're going to see more people requesting that. I'm a big fan. Okay, and then there's compliance. So, I mentioned I would be leery of anyone who didn't ask for proper documentation as far as if you're accredited or not, but on your end, verifying that the fund and the sponsor are actually registered with the SEC and have the necessary licenses to operate their business. Review your offering documents, have a private attorney look over the PPM, or if it's a Reg A, the offering circular. See if they have any red flags that pop up. Now, I will say PPMs and offering circulars do read like the back of a pill bottle. And that is what they are supposed to read, like not only giving the terms of, what's going on, how they're going to raise capital, how they're going to deploy capital, how it's going to be returned to investors, but it should also list out any and all risks that are associated with the offering. And then, like I said, engaging an attorney to review the investment structure, the documents, the risks, and if they know you, kind of give you feedback on and their thoughts. Understanding exit strategy. Now, it's one thing to allocate capital to a sponsor, but what is their exit strategy? What is the risk behind the offering? So I would say, what is the company's exit strategy on the specific assets that they're investing in? Also knowing how and when you can exit the investment. Like I said, some of these funds can be 1 year, 3 years, and some of them can be, 7 to 10 years. So what happens if there is a major life event, an emergency, and you need those funds? What does that look like? Can you get your money back? Are there penalties involved? Is there a death and disability clause? Understanding what rights you have to redeem and get your capital back. Asking about the risks involved and how does this company mitigate risks? Not only risks that they foresee, but also economic risks that they might not foresee. Understanding worst case scenarios and where you are in the capital stack. So I'm not going to pick on multifamily, but they always come up as a great example of this. So multifamily, a lot of them took out a lot of debt, multifamily funds took out debt, you want to be at the bottom of the capital stack. Now, think of it like a cake. The closer you are to the top, the more risk you have of falling. You want to be at one of the steady base layers. So typically what happens is you're going to have any investors, and then you're going to have the GPs above them or the sponsors. But if you have debt, what typically happens is the debt gets paid before the sponsor in a worst case scenario, or before the investors in a worst case scenario. So basically this question could be shortened to, do they take on additional leverage? Do they have any underlying debt? Because if they do, it's not necessarily a bad thing, but it is something you'd want to look at. Again, the climate, their strategy, their exit strategy, is it hinged on this debt? Because in a worst case scenario, if they did need to pay back that debt is due before investors get paid. So if the property is underwater, the bank is going to get their money, but investors might not. So understanding essentially if they're taking on additional leverage, where that puts you as an investor in the capital stack and getting paid back in worst case scenarios. And then reviewing the fund's historical performance and their asset classes market resilience. Again, is this a multifamily? Is it development? Is it mortgage notes? Is it oil and gas? How are these things affected by different economic climates? Transparency and communication. So evaluating the transparency of the sponsor. Can you call them and you're actually speaking to someone on the team? How do they communicate when you email them and have questions or are interested in speaking with someone? Will someone on the team answer if you call, or is this all outsourced overseas? And then, do your principles and interests align with the sponsors? I like to point out some red flags to look for when vetting a sponsor. So poor communication, at 70, it's really important to us that we get back to investors within 24 hours. Typically, it's like within a couple of hours. So how quickly are they getting back to not only investors, but people that are interested? Lack of experience. How many funds have they done? How long have they been in this asset class? I think the SEC requires 25 years plus to be considered not new. So that's, a good benchmark. Have they done this kind of fund structure more than once, or is this their first rodeo? Are there any conflicts of interest? Both from, do they own other businesses that are kind of correlated to what they're doing that they could benefit from? And then high fees. Are they saying you're going to get 12% return, but we're going to take a percent management fee, an acquisition fee, a disposition fee, and you're actually, after taxes and everything, you're really only netting, 6. So what are the fees associated with investing with this sponsor in this fund? And so a little bit about what we do at 7E. We invest in mortgage notes. Like I mentioned earlier, we fix and flip mortgage notes. It's a concept most people are familiar with because they understand the fix and flip market of buying a home that needs to be renovated and fixing it and selling it for a profit. We apply that to mortgage notes. This is a massive industry. What we do is really picking up what we're doing, and the amount of impact that we're having is we're picking up a grain of sand on a beach. That's how massive this industry is. You have anywhere from 200 to 500 billion floating around in non-performing debt, and about 13 trillion in single family residential debt. So when we talk about, what is a mortgage, what is a note, typically people view these as one and the same, but when you go to buy a house, you're actually signing two pieces of paper. You have your note, which is the promise to pay, the agreement between the borrower and the lender with the time, the terms, the conditions of the IOU, and that is secured by the physical property. Typically, in our case, single family homes. So you have a mortgage then that is the legal document that secures the IOU to the property. So in the case of default, the mortgage really gives the lender the right to go through that foreclosure process, collect the property as collateral. Mortgage note investing is essentially an alternative investment strategy. Now you can do this in ways of, in a fund structure. You can also do this as an individual investor. That's how I started out. I did use some qualified self-directed funds. I also use cash. So it is available to you outside of the fund structure, but it's essentially an alternative investment strategy that is secured by physical real estate. It's something that a lot of people are comfortable with because they understand that there is that security of the physical property, but they're not having to be the landlord. Instead, you become the lien lord, is what we call it. You're buying loans from hedge funds, banks, credit unions, or whole loan traders, typically at a discount, and becoming the lender. You're becoming the bank. You're sending that note to the borrower that says, hey, ABC Bank sold your loan to 70 Investments. We're your new lender of record. Please submit all payments moving forward to here. And then as the note holder, the investor, you purchase the right to the future mortgage payments and the right to repayment if they go into default. So you do have the right to foreclose should they decide not to work with you. Typically within the world of mortgage notes, there's kind of two buckets. You have your performing and your non-performing. Performing is when a borrower is paying on time per the terms of their agreement. And typically when you buy those are sold at anywhere from a 60 to 90% of the outstanding balance, depending on the loan's interest rate. Banks will sell these for all sorts of reasons. I'll give you an example. A lot of loans were originated during COVID that were 2-3%, and now rates are 6+%. So they're losing money on those loans. So for them, they can take a small discount, lose a little bit of money to get them off their books, and generate new paper that is also performing at 6% and make money. So a reason why banks would sell performing. Non-performing is when a borrower has failed to make their payments for at least 90 days or more, and the loan is in default. Typically, those are purchased for about 40 to 60% of the outstanding balance due, and those are sold by banks because they want to balance their books. It limits them from creating new debt if they have a certain amount of non-performing debt on their books. Banks are also great at creating debt. They're not great at managing debt. And if you've ever tried to call your bank and speak with an actual person about something like this, or even really anything, it's not easy. So they're really good at creating debt, really bad at managing it. So how note investing works is, in the case of 70, for example, we buy loans on single family homes at a discount to their unpaid balance. So for example, if there is a loan for 500,000 and it is non-performing, we're looking at a 40 to 60% discount. So let's say we get it for 300,000. The borrower still owes 500, but our investment in that is 300. So then there's really two routes to go here. For about 90% of our portfolio, personally, we're able to negotiate some sort of modification schedule with the borrower, which generates cash flow from those payments and then allows us to take that loan from a non-performing status to a performing status and sell it back on the secondary market, or the borrower will refinance or sell the home and the loan is paid off in full. So I'll give you an example of that. We had a borrower who lost his job, and by the time he found new employment, he was 30K behind and went to the bank to make a payment, And the bank said, well, that's great, but we're going to apply this to your late fees, past due, and arrears, which, unless you're getting a 30K lump sum, he's going to continue to accrue late fees. So when we purchased the loan, we worked with him. We put him on what's called a trial payment plan for 6 months, where he continued to make his monthly principal and interest payments. And then at the end of that 6 months, we modified the loan. And when I say modify, I want to be clear, we're not touching interest rate. We are either extending the term and attaching the arrears or past due to the end of the term, so extending it by a couple of months or years, or the borrower has decided, hey, I want to make quarterly payments or monthly payments towards my past due until I'm caught up. So again, that's how we're able to take the loan from a non-performing status to a performing status, which increases the value and allows us to sell it back on the secondary market. Now, there are, instances in which we are not able to come to some sort of agreement with the borrower, typically because they've decided they don't want to work with us for whatever reason. And we do start that foreclosure process, end up going through it. And typically we don't take ownership of the home. It's typically sold at third party, at auction to a third party, especially in this economic climate. And we are paid the full balance. So, and any outstanding any recoverable legal fees, I should say. So for example, if that same loan that we bought for 300K, we take to foreclosure, our opening bid we as the lender set the opening bid at the auction, it would be 500K plus, say we spent 20K in legal fees. So we would say our opening bid on this property is 520. Typically someone will come and pay more than 520 because that still is under value when the home is probably worth significantly more than that. So we would get paid off the full balance of 520 and someone else would assume the property. Mortgage notes as a passive option. So as someone who did it both passive and actively, and to be honest, I did get into it thinking it would be more passive than it actually was. But to do it right, you really have to be on top of it with each and every individual asset. So with mortgage note funds, you're looking for the passive cash flow without the headache. You are investing in the sponsor's capability and ability to manage the assets, manage the fund. As an investor, you are entitled to receive the specific dividends. Profitability and varying market conditions. So note prices function in relation to supply and demand. So let's talk about right now, for example, we are seeing a ton of notes hit the marketplace, and therefore driving acquisition costs on our end down because there's so much inventory. Now, during COVID, we didn't see as much inventory, but we were getting payoffs left and right because interest rates were so low. So there's ways to profit regardless of market conditions, and pretty much interest rate as well, because you are interest rate agnostic. Is when you bid on these assets, you're bidding based on a specific return. And then collateral. Real estate is something that I think a lot of people are gravitate towards because they view it as a safe investment. It's backed by collateral for that physical property. So a note is going to be less volatile than something that is, a stock or a bond, because it is secured by that physical property. Numerous exit strategies. So unlike some other asset classes where, they might really have to fix this property up, renovate it, get it rented, that's their strategy. There are many different ways in which we can work with a borrower to come to some sort of resolution, and multiple ways we can exit both the asset and get it sold, or the borrower refinances, or the borrower sells, or how are we going to work with the borrower. So you have numerous exit strategies within each asset that we're working, but also when you invest in a fund that has so many assets, you're not tied to the outcome of one individual property. So your risk is mitigated across all of the assets. So I know I kind of sped through that. I wanted to be cognizant of time, give people that chance to ask any questions that might have come up. But if you're interested in learning more about what we do at 7E, you can feel free to scan the QR code, book a call with me. I'd love to talk with you, learn more about what you're interested in, and answer any questions you might have.
So we did have a question pop up. When investing in mortgage notes with self-directed IRAs, does this require profits to go back to the IRA, or can they be received personally? I'll get that one, Lauren. They
Okay.
do go back to the IRA. The IRA is actually the owner, and even though it is your IRA account, I always like to say consider your IRA as your business partner. And if your business partner is putting up the funds to purchase the investment, then it is going to not only be responsible for all of the expenses related to that, but it's also going to receive all of the income. And you can really think about a more common investment we see in retirement funds like stock, where, it's sort of set it and forget it. You invest in the stock market and you don't even think about how that was paid for or how the income is received, but the IRS requires you to treat even alternative investments the same way. We had another question pop up. How do you find deals and how do you find the notes to purchase?
Yeah, so a lot of before COVID, it used to be a lot easier to get into this space as an individual investor. There were brokers that would send out lists where you could buy one-offs, you could buy two, you could buy three notes at a time. Um, After COVID and some of the regulations that the CFPB, which is the Consumer Financial Protection Bureau, put into place, it is significantly harder to come in as an individual investor unless you're willing to take down, a million in assets at a given time. There are still some lists that you can get on that do send out tapes that you can still kind of look through and bid on. So whole loan traders, back in when I first started, I was calling banks, credit unions, regional banks, a lot of credit unions actually, other funds to see what inventory they were looking to offload. So it really became more active from that stance in that I was selling, sourcing, and trying to find inventory. Now that I've been doing this for quite some time, as has my business partner, Chris, we have a good relationship and a good network of people that we purchase from. So we typically purchase from the same either other funds, banks, or credit unions that we purchased from in the past. So it's a very much a relationship industry, a lot more so since regulations have become tighter on investors doing this, because if a bank sells me a loan and I don't follow lending law or in that specific state, or if I'm not a licensed, or if I don't use a licensed servicer and something goes wrong, the borrowers can, and say the borrower decides to file a claim, which is not unheard of, it will not only come back on me, but it will come back on all the banks prior to me. So they're very cautious about who they sell to, making sure that these people know what they're doing in the space as well. Not impossible to get into as an individual investor. If that's something you're interested in, again, feel free to email me or book a call with me. I'd be happy to point you in the right direction. My email, I don't think I have it on here, is just Lauren at 7 investments.com.
We also had some questions pop up about investing in the fund, but I'm going to leave that to an offline discussion. But I did want to also point out, and Lauren, I don't know if when you first got started you did any of this, but networking with your local real estate groups can also lead you to conversations with people about notes. I personally host an exchange, and in the exchange, people bring non-performing notes all the time. And why would they do that? Because they don't really want to do the legwork. Like Lauren said, sometimes it's not as passive as you
Yeah.
want it to be. And so they say, hey, it's got good collateral. They're behind, I just don't want to renegotiate with the borrower. I'm not, I don't want to foreclose. That's not really my wheelhouse. And so you might, if you do some networking with your local real estate groups, and there are so many of them out there, you might find that there are non-performing notes or even just people willing and looking to borrow private money. I do some private money lending with my 401k, and so that is definitely out there as well. And so it's something to just be aware of. And also you do learn a lot by networking with your local real estate clubs. I did not see any other questions pop up. We were asked a couple times, would we make this webinar available for downloading? Yes. Since you registered for it, you are going to receive a copy of the recording. So that usually goes out at the end of today or sometime tomorrow. And so just watch your inbox, you'll get a copy of it. And if you want a copy of the slides, we're happy to share them. I'm sure Lauren can share them with you, and I can as well. When you get the recording, you'll have a spot in there where it'll say if you want a copy of the slides, you can reach out. So you will definitely be able to do that. I had another request for the slide. Just go ahead and reach out to us because we don't have a way to pull your contact information during the webinar. But if you would just send an email to me or reach out to Lauren, I'm sure she can share the slides with you as well.
Yeah.
Lauren? Go ahead.
Yeah, feel free to reach out. You can reach out to me again at Lauren@70. And if you are interested in learning more about what we do, feel free to go to our website. We have a ton of information on there. We have a newsletter you can join. We don't spam you. We send you case studies once a week. So it's just a way for people to get to know who we are and what we do. So feel free to head on over. It's just the number 7, einvestments.com.
Great. Thank you so much, Lauren. Thanks for joining us today. And everyone, thanks for joining the call. If you have questions, let us know. Thank you.